Two borrowers on this particular file. Actually, the first borrower had a bankruptcy, which was discharged in December 2020. So it had dropped off the bureau already. Borrower 2 had zero credit issues aside from one over limit credit trade. Both good to great credit.
These are the type of borrowers that you can see, maybe they had a mishap. You don't know what caused their bankruptcy. There's a lot of things that are out of their control even, but a lot of banks just simply because okay, it's sub 5 years, we're just not interested in doing it, or we're going to give you a high risk loan or whatever it may be.
Yeah.
So it's nice to be able to step in and say, look, this person's back on the ball and we can get involved and help you do what you want with your home.
Absolutely. We're sometimes referred to, as a storybook lender where, we'll listen to the story and understand. And you're right. It is really cool to be able to go through this and evaluate and say, you know what, regardless of the situation that you had in the past, we still see opportunity here for you and a good solution for you with this product.
Thanks for tuning in to the Canadian Private Lenders Podcast, the show about starting a private lender in Canada, the mortgage industry, and the real estate industry. Your hosts are Neal Andrino and Ryan McNeil. Enjoy.
All right, everybody, welcome back. It's episode 53 of the Canadian Private Lenders Podcast, sponsored by Mortgage Automator, with your hosts here, Ryan and Neal. Neal, how you doing today, buddy?
Great as always.
Awesome.
A little cold. It's winter here now.
It's chilly. We're talking November now, right? So it's we're feeling it. We're feeling it after a nice summer and early fall, right?
100%. I left my car out overnight and I got here this morning and hit the wipers and it kind of made the crunchy sound. And I was like, oh no.
Here it comes.
Here we are.
Yeah.
But
you come to it every year, right? This is part of the process. But
I'm moving to Portugal. Anyways, actually, it gets kind of cold there too.
Does it? Yeah, I guess it's probably coastal weather there, eh?
Yeah.
Everybody talks about how awesome Portugal is. Have you ever been?
No, I haven't. And
Neither have I.
Everyone is going on and on. I'm like,
everybody loves Portugal. I've never heard a bad word about Portugal.
No,
not a single one.
I think we should add that to our lending territory.
Maybe, yeah, that'd be a good excuse.
I guess we got to go check out some property,
some conferences over in Portugal.
I'm in.
I like it. Neal, today we're going to bring up a deal example today, which we love bringing these up. We've done a handful of episodes like this, but this is we like to call these relocation loans. They're really bridge loans, but maybe a bit longer term bridge loans. They typically end up being, I'd call it 3 to 6 months on average. Great use of private funds, but we're going to go into detail on one we did specifically here. Just closed last week, actually. And there was some exceptions that we allowed for this deal. So we just kind of want to walk through the details of that and how we get there.
Sweet. Let's do it.
You want to kick us off?
Yeah. Okay. So this was a bridge loan that we did. I don't know when we did it, but you guys...
It was just a couple weeks ago.
Okay. Yep. And so the client was purchasing an owner-occupied property. It was a mobile home, which I don't think is something that we typically look to lend on. And a bunch of lenders have concerns with them for a ton of different reasons. It might be, formally, it's because they're not fixed to the property.
Yeah.
That is...
This one here was this, right? This was a mini home on a foundation.
Okay.
So, but yeah, I mean, it kind of goes in the same thing. So typically a mini home or mobile home is usually a hard no for us.
Yeah. And for a lot of lenders, honestly.
Yep,
on the sales side, I've faced difficulties. The other thing is the amortization on them sometimes will screw up the loan to value, because if the mini home they basically value them at 25-year lifespans unless it's been redone and they can prove that the value's there. And so sometimes they'll be like, well, this one's 14 years old. We're only willing to take a loan to value of 40% due to the fact that it can only be stretched out. The amortization can only be stretched.
Depreciates much faster than other assets, right?
Yeah.
And not to go on too much of a tangent here, but while we're on the subject, it's interesting to see how much the price points are increasing on mini homes now.
It's
right?
psycho. It's insane,
right? Like 3, 4, 500,000. This was literally $500,000 purchase, right? Mostly because of the lot.
Yeah.
But it's just very interesting to see that. And I do wonder if lenders are going to change their attitude about these as more and more smaller homes become the norm, and it resonates with that affordable price point.
I think they've been around long enough now that they're going to see that they actually do last as long or longer.
Yeah.
Because they're manufactured inside. There's a lot of great technology that's been developed to build these.
Yep.
It's the same as any property where if it's maintained, it'll last pretty much forever.
Yep.
If not maintained, then it'll fall apart. I also don't think there's a problem with them getting just hitched to a trailer and someone towing the the home away. I don't know that that's actually a thing of people removing them very quickly.
You'd see that often on maybe leased land where someone owns the mobile, but they lease the land.
Yep.
Nobody lends on leased land. And I mean,
Yeah.
I'm sure some lenders do out there, but I mean, it's in my opinion, not smart lending practice, very high risk.
Yeah.
Because like you said, you could hitch it to a trailer and move it away. And then you have no asset. But, you know, I've never done a leased land loan. It's too risky. It has to be owned land to even consider it.
Yeah. I'm curious how that's going to pan out. Maybe do that in another conversation, because in the States, they do a lot of HOAs, where it's homeowners associations. And I don't know if it's leased land or they own the land. And maybe it's a mixture of the two. But anyways, very popular in the States.
Yeah.
But here, not a super popular thing. This situation was different. The mobile home is on a foundation on owned land that was also lakefront.
Yeah, exactly. So I'll take you through a quick deal overview here. So the borrower was purchasing an owner-occupied property on a well-maintained mini home on lakefront land within Halifax Regional Municipality, HRM.
Yep.
Okay, so you know, good location, good land now. But as mentioned, you know, mini homes are typically outside of our lending criteria. We made an exception on this one for a couple reasons. One, the prime location of the property, and of course, we had additional security, and this is the most important piece. So the client's existing home hadn't been listed, and that's why we're calling this a bridge or a relocation loan here. The client saw this lakefront property. They didn't need as much space anymore. They were downsizing to this mini home. They said it was a perfect fit for them. But they had a semi in Lower Sackville, which is also inside of HRM. And this property was actually free and clear. They had no mortgage on it anymore. It's worth, you know, around $500,000.
Amazing.
Yeah. So we're like, perfect. You know, this is a scenario. We'll make an exception for you here because we got excellent security.
100%. And so I'm going to get into the security and how that looked, because it is a little different being a mini home, even though it is on a foundation.
Yep.
So this is how we set it up. First, we took what's called a chattel mortgage over the mini home. Again, because it can be moved, even though formally in this case, I don't think it could be. We have to take it and register it like that. Then we also registered a mortgage on the actual physical land in first position. So that's the land that mini home is sitting on that they're looking to move into and we're buying. And then really where the value comes into it and where it made it all work was that free and clear home that they owned in Lower Sackville. We also took a first position on that. So there was a ton of coverage to ensure that we had lots of security in the event that there was any sort of issue. If there was still some sort of first place mortgage on that home that they lived in, we would have had to take a second in that place. But we would have, again, been very scrutinizing on the fact that is there actually enough equity in that to cover us in the event of, obviously, of default.
Yep, absolutely. I've been in the private lending game for a while, and let me tell you, Mortgage Automator is the ultimate software for private lenders. It's been a total game changer for our business. I've scaled 2 private lending companies, and I couldn't have done it without this software. The Mortgage Automator team truly understands the challenges we face, and they're constantly thinking ahead. For example, they've developed new anti-money laundering and know your client tools to keep you compliant with the latest FinTrack regulations, and their platform is SOC 2 compliant, ensuring your financial data is secure. This software eliminates almost every admin burden you can think of in the private mortgage business, saving us thousands on staffing costs. No more manually typing term sheets or tracking files in Excel. So whether you're a new private lender looking for an efficient solution or an established lender aiming to scale up, Mortgage Automator is the solution for you. See if Mortgage Automator could be a good fit for your unique lending needs at www.mortgageautomator.com/switch. Let's talk about the borrowers themselves here as well, because this obviously plays into a loan like this. Obviously, you know, we're very happy with the security on this overall, but we got to still make sure, you know, what if that property doesn't sell? What if it takes 6 months longer to sell? Can they still make the payments? So 2 borrowers on this particular file, husband and wife, and actually the first borrower had a bankruptcy, which was discharged in December 2020. So it had dropped off the bureau already. They'd actually reestablished their credit very well post-bankruptcy, had good credit above 700. Borrower 2 had 0 credit issues aside from one over limit credit trade. Credit was still in the mid 700s. So both good to great credit, and also both had strong incomes. I think they were, you know, call it combined $175,000 annual income. So they had enough funds to cover payments while the loan or through the loan term.
From my perspective, this is where I think, again, as a private lender, it's almost a feel-good situation, because these are the type of borrowers that you can see, maybe they had a mishap. You don't know what caused their bankruptcy. There's a lot of things that are out of their control even that could have led to that situation. Sure. Like if you own a business and December 2020, like it's COVID and you're running on fumes and then COVID hits and kills you. Like, can you really be like, this person's a terrible person to bank with? But a lot of banks, just simply because like, okay, it's sub 5 years or 10 years, we're just not interested in doing it, or we're going to give you a high risk loan or whatever it may be.
Yeah.
So it's nice to be able to step in and say, like, look, this person's back on the ball and we can get involved and help you do what you want with your home.
Absolutely. Another benefit of having the flexibility of being a private lender, we're sometimes referred to, as a storybook lender, where, we'll listen to the story and understand it. And you're right. It is really cool to be able to go through this and evaluate and say, you know what, regardless of the situation that you had in the past, we still see opportunity here for you and a good solution for you with this product, right? It's more so when you're evaluating these bankruptcy or past bankruptcy or discharge bankruptcy. Is there an exit on the back end for the client, right?
Yeah. This
one here's a little bit easier, right? You're moving into property A, you're going to sell property B, you're going to use proceeds of property B to pay out the loan. If it's a standard, I got into credit troubles and I had to go bankrupt, and now I need a private lender to step in, and I might have a solution from a B lender 2 years from now, or an A lender 3 or 4 years from now. That's a little bit tougher. You gotta scrutinize that one a little harder.
100%. This would be kind of cool for them because they're probably going to pull some equity out of this, and now they're going to go to lakefront living.
Exactly. Yeah, not a bad deal. Those pieces of land don't tend to depreciate too much in value.
Yeah.
It's kind of just outside of core Halifax, Dartmouth, I'd say, where this property is. So those areas are, continuously appreciating in value. More and more people want to live, oceanside living.
Yep.
But just in summary here, Neal, this deal basically highlights the flexibility of private lending, right?
Yep.
As mentioned, mini homes are typically not a target for us for financing, but with the location combined with the security, the property in Lower Sackville, as mentioned, it allowed us to structure a deal that met the client's need. And by providing this bridge financing, we enabled the client to get that dream property while selling their existing property on their timeline, right? So if they need to do a couple minor renos or, finish up things with, a given job or whatever they may need to do, it gives them time to do that.
This is making me think this kind of, I feel like is what is considered the net worth program that everyone talks about in Ontario, where a lot of people have a home worth millions of dollars and it's maybe paid off or very low loan to value. And then they want to buy. That's the
only lending program in Ontario.
Because, exactly. They definitely don't income debt service their next house.
Yeah, equity lending.
So they equity lend to get into their next place. And I don't want to say unfortunately, but they get to do it with grade A banks because the size of the loan is big enough that they feel that it's worth their time, combined with they feel that there's enough risk mitigation because it's like a big, beautiful house or whatever it is. Unfortunately, those programs aren't offered to someone like this, where it's still their existing free and clear home is probably $500,000, but that wouldn't qualify them for any sort of net worth programs. And so it's almost unfair if you're in that position where you're like, well, how come he can do it just because he has some big fancy house? He gets this opportunity to now not have to leverage his money. So again, it's kind of a feel good in some ways that borrowers or lenders like ourselves can help them do stuff like that. So they also have these options. Like, well, I'm tied to my house. I had a bankruptcy 4 years ago, but I've got my shit together. I have all this. I have investments. I have cash savings. I have all this equity in my property, but I'm still looked at less favorably than the guy that's got all this debt strapped to this big fancy house. So anyways, I'm just like, this is again showing the value that a private lender has, and they're not getting away from that predatory concept. I just get tired of hearing that sometimes.
Well said. And in summary, private lenders can offer solutions that traditional lenders can't, right?
Yeah.
We offer that flexibility, and it allows private lenders to thrive in niche markets with products that work for short-term solutions.
100%.
Anything else, Neal?
No.
That's it for today. Thanks everybody for listening.
Thanks, guys.
Cheers.
Hey guys, it's Neal Andrino, your co-host and your co-founder at Keystone Capital and Director of Investor Relations. I'm also a real estate agent, real estate investor, and business owner.
And your co-host here, Ryan McNeil. I'm the co-founder and president of Keystone Capital Group. Keystone Capital Group is licensed under the Mortgage Regulations Act of Nova Scotia, license number 3000549, and through FCMB, license number 88799. And keep in mind, the views of this podcast are for informational purposes only and is not financial advice.